Hello, I'm Kevin Gallagher, Santos' Managing Director and CEO. Welcome to this presentation of Santos' 2021 full year results. I'd like to start by acknowledging the traditional lands of the Kaurna people of the Adelaide Plains, where I am speaking to you from today, and I pay my respects to their elders past, present and emerging. I also acknowledge the traditional owners of all of the areas where Santos operates, including in PNG, Timor-Leste and Alaska. I'm pleased to present yet another strong set of financial results that demonstrate the strength of our disciplined, low-cost operating model. They are record results, the highest revenue, free cash flow and underlying profit in Santos' history. They also highlight how the merger with Oil Search delivers increased scale and capacity to drive our operating model and unrivaled growth opportunities over the next decade. I have long talked about the energy transition, creating significant opportunities for both Santos and Australia to establish a new, large-scale industry safely and permanently storing carbon through carbon capture and storage, and generating valuable high-integrity carbon credits. Those credits will be in high demand from emitting countries that lack Australia's competitive advantages in carbon storage, in particular our existing LNG customers in Asia. That's why we're exploring a multi-hub CCS strategy, including Moomba, Bayu-Undan and offshore Western Australia. There's a real value accretive business opportunity for us, as well as the imperative to achieve our target of net zero Scope 1 and 2 emissions by 2040 and help the world to decarbonise without compromising energy security or affordability. I'll begin today with some opening remarks about our performance before handing over to Chief Financial Officer Anthea McKinnell to discuss the financial results in more detail. Before we start, I draw your attention to the usual disclaimer. The merger with Oil Search has created a company of size and scale with a unique diversified portfolio of long-life, low-cost oil and gas assets. The result is a company with strong free cash generation, which provides a platform for sustainable growth and shareholder returns. You have heard me say before that I believe our industry must be in a position to self-fund growth and the energy transition to cleaner fuels. I believe the merger has created a company well placed to achieve this goal. Had the merger been in place for all of 2021, we would have generated over $2.3 billion in free cash flow. The merger also added significant 2P reserves and unrivaled growth opportunities across LNG, low-carbon liquids and CCS. The balance sheet is stronger, with gearing reduced to 27.5% at year-end. And importantly, the merger builds on our industry-leading approach to ESG through the combination of Santos' net zero pathway with Oil Search's unique social and community investment in PNG and North America. This slide summarises the financial results for the year, a truly impressive set of numbers. We set new records for sales revenue, free cash flow and underlying profit. Strong operational and cost performance, combined with higher prices, delivered $1.5 billion of free cash flow, up 103%, and underlying profit of $946 million, up over 200%. I remind you that these reported results include only 3 weeks of the Oil Search assets. If we include them for the full year, then free cash flow from the merged company would have been over $2.3 billion. Pleasingly, the board has declared a final dividend of 8.5 US cents per share, a 70% increase on last year's final dividend. The dividend is franked to 70%, and consistent with our sustainable dividend policy is 20% of free cash flow for the merged entity. Slide 5 shows how the business has delivered strong free cash flow over the past 6 years by sticking to the strategy and operating model we announced at the end of 2016. We've now delivered more than $5 billion in free cash flow since 2016. include the oil search assets for all of 2021, and that would have been more than $6 billion. In 2022, we are targeting a free cash flow break-even oil price before hedging of less than $25 per barrel. And for every $10 the oil price is above our free cash flow break-even, the portfolio generates around $450 million in free cash flow before hedging. As I have always said, cash is king. And at current oil prices, Santos is generating a lot of cash. This cash allows us to fund growth, fund the energy transition, and provide returns to shareholders. Our journey to become Australia's safest operator continues. Always safe is a core value at Santos. Our expectation is that every day, everyone who works at Santos is focused on keeping themselves and their workmates safe and going home healthy every single day. COVID-19 has provided a unique set of challenges. Our focus has been on protecting our people while keeping production flowing to meet the needs of our customers. This has placed enormous pressure on our staff, with some enduring lengthy quarantine periods and longer swings. I want to recognise all of our staff for their efforts during this once in a 100-year pandemic. However, I am disappointed with our safety performance. We had 12 lost time injuries last year, and I am very focused on ensuring that we learn from these events and that we drive for even safer workplaces and fewer safety incidents. Our performance on process safety was much better, with loss of containment incidents reduced to the lowest level in 5 years. Our reserves and resource position has been transformed through the merger and the final investment decision on the Barossa project. 2P reserves increased by 80% to 1.7 billion barrels of oil equivalent. The merger added 416 million barrels in PNG, including a much higher interest in the world-class PNG LNG project. And Barossa final investment decision added a further 373 million barrels at our 50% interest, following the sell-down to JERA. 2C contingent resources increased by 40% to 3.2 billion BOEs, with the largest increases associated with Papua LNG and the Alaska projects. We also announced a booking of 100 million tonnes of CO2 storage resource in the Cooper Basin. This follows FID on the Moomba CCS project in November. We see CO2 storage as a strategic competitive advantage in evolving cleaner energy, clean fuels, and carbon markets. This globally significant capacity is another tangible example of Santos leading the way in establishing the foundations to support the energy transition. With carbon spot prices above $35 per tonne in Australia and higher still in Europe and elsewhere, CO2 storage has the potential to be a very valuable resource in a lower carbon future. 2021 brought global energy security into the spotlight, with higher prices and a supply crunch in the wake of rapidly recovering demand and a lack of investment in new supply. Oil demand is expected to reach pre-COVID levels this year. Investment in new low-emission supply projects are needed to ensure reliable and affordable supply during the energy transition. Our Dorado and Pikka projects fit into this category with low emissions intensity. LNG demand is also at record levels, with underinvestment driving significant price increases, as we have seen in Europe, and limiting access to energy for those who can least afford it. It is vitally important that investment in new supply occurs in a sustainable way. At Santos, we are focused on supplying critical fuels more sustainably to meet society's demand. Driving investment in new supply to less transparent producers will not reduce global emissions or advance the transition to net zero. Our Moomba CCS project which will be one of the biggest in the world, paves the way for a significant carbon reduction and storage story for Santos and for Australia. We are also exploring a potential multi-hub CCS strategy across our operating footprint. Decarbonising natural gas supports the long-term supply of reliable and affordable energy, as well as the production of clean fuels, including hydrogen and ammonia. As the head of the International Energy Agency has said, reaching net zero goals without CCS will be almost impossible. Santos is committed to supplying critical fuels more sustainably. In 2018, we were one of the first companies in our industry to state an aspiration to achieve net zero emissions by 2050. In 2020, we raised the bar again, setting our new target to achieve net zero Scope 1 and 2 emissions by 2040, along with a new medium-term target of a 26 to 30% reduction by 2030. Our decarbonisation pathway is focused on operational efficiency and CCS to avoid and reduce our own emissions and carbon reduction solutions, including nature-based offsets and new technologies like direct air capture. We're also committed to working with our customers to help them reduce their Scope 1 and 2 emissions by 1 million tonnes per annum by 2030. We are committed to transparent reporting and disclosure through our suite of ESG reporting available on our website. And next month, we will release our 5th annual climate change report, consistent with the TCFD guidelines. This report will outline Santos' climate transition action plan and demonstrate alignment of capital allocation with the Paris Agreement. I said earlier, the merger has delivered a stronger portfolio of long-life, low-cost assets with significant growth potential. It has also delivered high working interests in some assets and development projects. This year, we will seek to further optimise the portfolio, reduce gearing and future capex, and conduct a review of the capital management framework, including returns to shareholders. This will ensure we are in the best position to provide returns for shareholders, reduce debt, invest in growth, and invest in the energy transition. Santos has a proven track record in delivering integration synergies from acquisitions. The Quadrant and ConocoPhillips acquisitions delivered over $160 million in synergies from areas like duplicated overhead and corporate costs, capex and opex savings through applying our low-cost operating model. For the Oil Search merger, we are using the same approach. I am pleased with how our team has hit the ground running and is delivering some early wins, with around $30 million in synergies captured already. We are on track for our target of between $90 and $115 million in annual synergies. Each year, I like to set out our strategic priorities so you can monitor our progress. Our first priority, of course, is maintaining a safe and strong base business with a free cash flow break-even of less than $25 per barrel. We want to keep the business functioning efficiently and keep it low cost, and that's what our long-life assets with steady production profiles allow us to do. All activities within that base business are self-funded within our disciplined operating model. The second priority is to deliver the merger synergies target as promised. Our third priority is to optimize the asset portfolio. The fourth priority is to review the capital management framework, including returns to shareholders. The fifth priority is to continue to execute the Barossa LNG and Moomba CCS projects on schedule and on budget. And the sixth is to complete FEED on the Dorado and Pica Phase 1 projects and have them ready for final investment decision around mid-year. In summary, it was a great year for Santos. The business is running well and our operating model sets us up for disciplined growth. The merger with Oil Search has created a regional champion of size and scale. With size and scale comes the opportunity to accelerate our aspiration to becoming a clean fuels company and reaching our net zero commitment by 2040. I'll now hand over to Anthea to provide a detailed review of our financial results.
Thanks, Kevin, and hello to everyone. Santos delivered a very strong financial result in 2021, and I'll go through these in more detail over the next few slides. The three key financial priorities for the business have not changed. Firstly, we continue to focus on generating free cash flow from the base business. As Kevin previously stated, we achieved strong free cash flow of $1.5 billion in 2021 as commodity prices recovered, and we continued to focus on managing costs. Had the merger been in place for the full year, we would have generated more than $2.3 billion in free cash flow. This shows the cash generative ability of the merged group as commodity prices rise. Our free cash flow break-even oil price in 2021 was $21 per barrel, and we're targeting less than $25 this year. The second priority is ensuring that our capital allocation process is disciplined during our growth phase. Growth projects will be phased and equity levels reviewed consistent with disciplined capital management and our operating model. We expect to complete the sale of a 12.5% interest in Barossa to JERA in the first half and are targeting further asset sales as we seek to optimise the post-merger portfolio. We will review our capital management framework, including returns to shareholders. And finally, Santos's balance sheet is ready to fund growth. Strong cash flows have reduced gearing to 27.5% at the end of the year. This is well within our current target range. We carry strong liquidity of $5.6 billion and net debt stands at $5.2 billion. We plan to optimise the debt portfolio by cancelling the legacy Oil Search non-PNG LNG financing facilities. This slide shows a strong set of results for the year, driven principally by strong performance from the base business and higher realised commodity prices. Sales revenue increased 39% to just over $4.7 billion, which is a record for the company. Higher oil and gas prices led to an EBITDAX of $2.8 billion, up 48%. Underlying net profit after tax of $946 million was also a record and more than double the previous year. Reported net profit after tax includes losses on commodity hedging, costs associated with acquisitions and one-off tax adjustments. Free cash flow more than doubled to $1.5 billion and the full-year dividend of 14 cents per share increased by a similar amount. The dividend is in line with Santos's sustainable dividend policy, which targets a range of 10% to 30% payout of free cash flow. The final dividend of 8.5 cents per share equates to 20% of full-year pro forma free cash flow for the merged entity, less dividends paid in the first half by both companies. The final dividend is franked to 70% and substantially distributes the company's remaining franking credits to shareholders. And whilst highly dependent on activity, sales mix and commodity prices, based on our carry-forward tax losses, Santos does not expect to generate franking credits for the next several years. The final dividend will, however, be designated as conduit foreign income, allowing it to be paid to non-resident shareholders free of Australian withholding tax. The strength of our diversified portfolio throughout the commodity price cycle is best highlighted through free cash flow generation. The charts show actual cash flows and also pro forma cash flows, assuming the merger had been in place for the full year. And this really highlights the cash generative power of the merged entity. On a pro forma basis, the merged entity generated over $2.3 billion in free cash flow for the year. The trend in earnings metrics is a similar story to cash flow, although here I'm showing only the reported results, which include 3 weeks' contribution from the Oil Search assets. Sales revenue, EBITDAX and underlying profit were all records. Underlying more than doubled to $946 million. Production was a record 92 million barrels of oil equivalent in 2021, which included 1.7 million barrels from the Oil Search assets. Guidance for 2022 is 100 to 110 million barrels. We see higher production in PNG due to the merger. There is significant uncertainty in Bayu-Undan as it approaches end of field life. We expect that our share of production from the asset in 2022 will be approximately 10 million barrels less than last year, due to a lower average working interest following the SK sell down, the lower gross production due to natural field decline, and a lower PSC net entitlement due to higher forecast LNG spot prices. Sales volumes are expected to be in the range of 110 to 120 million barrels. Our focus on safe, low cost and efficient operations is continuing to drive cost reductions, which is reflected in the group unit upstream production cost of $7.76 per barrel of oil equivalent, down 3% from the prior year. Sustained cost improvement and synergies from the ConocoPhillips acquisition were partly offset by increased costs associated with managing COVID-19, particularly for quarantine requirements to ensure we could maintain production. At a group level, COVID-related costs added around 20 cents per barrel of oil equivalent, while a stronger Australian dollar FX rate added a further 45 cents. So given the headwinds of these extra COVID-19 and foreign exchange pressures, this was a good result for production costs. In 2022, we're expecting unit production costs in the range of $8 to $8.50 per barrel, which is impacted by the decline in Bayu-Undan production. These charts show how the operating model continues to drive strong results across our operated assets. We've maintained our focus on low cost and efficient operations. As the charts show, cost reductions are occurring and being maintained across our offshore assets, and this is reflected in the group unit upstream production costs for the base business. Our onshore business has also delivered underlying cost reductions, which were offset by COVID-related costs, foreign exchange movements and lower volumes in the case of the Cooper Basin. This table shows a snapshot of the full year results outlining the strength across our core assets and the balanced nature of their contributions to EBITDAX and margins. Western Australia, Northern Australia and PNG are our highest margin assets, with strong stable cash flows, low costs and margins in excess of 80%. This really emphasises the value that was added to the portfolio through our strategic acquisitions in Western and Northern Australia and the Oil Search merger. All our core asset segments have margins greater than 40%, and overall our group EBITDAX margin remains strong at 58%. Reported asset results include our portfolio of midstream infrastructure assets comprising Moomba, Port Bonython, Darwin LNG, Varanus Island and Devil Creek. These assets generate stable and material cash flows from existing, internal and external tolls, and the results include EBITDA of around $370 million for the year. We seek to continue to drive costs out, both through the operating model and synergies from the Quadrant and Conoco acquisitions and the Oil Search merger. Turning to CapEx, 2022 CapEx guidance in the base business is $900 million for sustaining and $200 million for restoration. Importantly, this spend is self-funded within the disciplined operating model and included in forecast free cash flow break-even of less than $25 a barrel in 2022. I've provided a breakdown of this on the slide, and it includes ongoing drilling activity in the onshore assets and the Apis and Pavo exploration wells adjacent to Dorado, offshore Western Australia. In the Cooper Basin, we plan to drill around 100 wells after a significantly lower level of drilling activity last year. We also plan to ramp up in GLNG with around 350 wells planned. Major project CapEx for committed sanctioned projects, including Barossa, Moomba CCS, Spartan and Angore, is set out on this slide. There is also a contingent unsanctioned amount of $400 million that would be added should the Dorado and Pikka projects take FID at our current equity levels. This CapEx, including the contingent amount, can be funded from free cash flow in 2022 at an average oil price of $65 a barrel. I've shown this on the chart on the slide using our 2022 free cash flow sensitivity of $450 million for every $10 the average oil price is above our break-even. All guidance assumes our current working interest in all projects and target FID and feed entry dates. As I said earlier, we are seeking to optimise the portfolio through targeted sell downs, which would also reduce CapEx exposure. Net debt was $5.2 billion at the end of the year, including $873 million lease liability under AASB 16. Gearing has been reduced to 27.5%, which includes the lease liabilities. There is liquidity in place of approximately $5.6 billion, comprising $3 billion in cash and $2.6 billion in committed undrawn debt. With a strengthened balance sheet, we are ready to fund our growth projects, and we have flexibility to optimise the portfolio through farm outs and disposals. In closing, the disciplined free cash flow focused operating model continues to drive shareholder value through lower costs, improved capital efficiency and increased returns. We're seeking to maintain a free cash flow break-even at less than $25 per barrel before hedging and deliver strong free cash flow in this current commodity price environment. We are targeting some asset sales as we seek to optimise the post-merger portfolio. We will then review our capital management framework, including returns to shareholders. The balance sheet is well positioned to fund our growth projects, provide sustainable dividends, and we are well positioned to deliver this next phase of growth and fund the energy transition. Thank you, and I'll now hand back to Kevin.
Thanks, Anthea. In summary, as I said at the outset, I'm very pleased to present a record set of financial results. The business is performing well, as you can see in the additional slides in the asset performance section of the presentation released today. We have been and remain unrelenting in sticking to our strategy and implementing our disciplined low-cost operating model, an operating model that has proven its value by delivering consistent results, keeping the business resilient and performing strongly. We continue to generate strong free cash flows, maintain the strength of our balance sheet and provide dividends to shareholders. Thank you for watching.